I really would like to go through the macro show slide deck, because again, that's going to give you another great avenue in regards to what what data pieces and what's the construction in regards to the time frames that we should be looking at. I believe Eric's going to pull up the one from this morning. Again, I'm going back to two out of three key pieces, pillars that I think are quite crucial to executing on the process really well. And so that's really the macro show. As I said, macro show, early look, risk ranges. The early look gives you great analysis every day, and the macro show really runs through the data and puts it together in a very tight format. So again, if we kind of start with, we can skip the top three things, Generon, but just sort of go into the kind of where the data starts, really. There you go. Chart call outs. Perfect. Awesome. So again, we kind of we can go through these relatively quickly. If we can stop on spend some time on the U.S. sectors, Eric, and then kind of the volume and those kind of things, right? So we'll go. So these are chart callouts, right? So chart callouts will be just important aspects within the deck that we find every day, right? So these will shift. So natty gas was highlighted today. CR commodities, Turkey versus Nasdaq. These are all very important ones, and often Keith kind of teases these out on Twitter as well in the morning. But these are ones that again, this is important, right? This is information that Keith has reviewed the evening before or that morning, and relaying to all of his clients across the board as to components that are quite important. Now we get into a bit more of the macro grind aspect of within the deck, and that's where we get into the individual kind of pieces of the puzzle and the data, right? So it starts with the sector performance. This is a great, again, this is a key component, right? So in terms of my process, this is just mine though, guys, right? So that, if you don't trade US sectors, then, fast forward on this or when you're rewatching it. But there's a reason why it's in the deck every week or every day, excuse me, and why we highlight it and provide it, put it into in here every single day. So, we go through the US sectors, and again, this is 1 day, month to date, quarter to date, year to date. So these are important timeframes, right? You're going to see repetition here in terms of the timeframes that are important and impactful. So here's the sector performance. Then we do it on a relative basis, right? So reviewing kind of how within the U.S. sectors, obviously, how are things acting or outperforming or underperforming compared to other sectors. Then we go into volume, right? So if we review the VASP model, Keith's VASP model, that's comprised of the three-factor model: price, volume, and volatility. So the first one is around price. This next slide is around volume. So volume was down day over day. Again, look at the time frames: day over day, prior day, month over month, 1 month, or sorry, this is 1 month average, 3 month average, 1 year. Apologies, but basically same concept, right? Day over day, month over month, and then 3 months. Then if we go to the next slide, we got sector performance, factor performance. So again, if you look at this one, was really a key one from when I was getting going in terms of providing the time frames, right? The time periods. You had the 1 day, the 1 week, 1 month, 3 month, 6 month, year to date. So again, 1 day, 1 week, 1 month, 3 month, 6 month, year to date. If they're important enough for Keith to be showing this on the factor performance slide, it should be important to you, right? So pay attention to what he delivers or what we deliver as a team. Next slide, please. Key US dollar correlations. Again, we go through 15-day, 30-day, 90-day, 120, 180, that kind of thing. But again, this is, US dollar correlations. So again, the correlations are important, but do you need to know the correlations between every asset class, within every ETF? Maybe not, right? So this is where, again, the team has back tested a lot, all of this data, and some of the key ones to call out daily would be SPX, Brent, CRB, aka Commodity Index, and gold. If we go to the next slide. Here we go. So now we're getting into a bit of additional data here, right? So we're getting into fixed income. So this is the U.S. yield curve. So in particular, the 2-year, the U.S. 2-year, 10-year, and then the 2-10 spread. What that looks like. Again, if you kind of move over to the right where the colors are, you've got day over day, week over week, month over month. Now within that, so again, if you kind of are paying attention to the particulars, you'll see that we look at it from a rate of change standpoint, from not only as a basis point, so basically, the change in price really, but also on a percentage basis, on a percentage change as well. So, for me personally, I write down the basis points because I think that's, especially for in fixed income, a bit more valuable. And then I look at, and then I specifically write down the percentage change on a month over month basis to capture a bit more of that trade duration. So trade is 3 weeks or less. 1 month is 4 weeks, but you get the point, right? So keep going down if you don't mind. Again, this is market expectations. So again, rate hikes. This slide, I would have to go back. I don't know if this slide was actually even in there when I first started back in 2020, but certainly, obviously, an important one here. As the one of the key narrative driven components is the Fed gonna stop or alter or pivot their Fed hikes, right? So this is expectations. What you should have noticed is that plus 0.15 turned positive. I believe it was yesterday for the first time. Nope, sorry. Yesterday, I thought it was positive today for the first time. Yesterday was negative 0.02. Today was plus 0.15. So again, these are things. It's starred in the notebook. Can you see this? Hold on a second. It's starred right here. See that? Right there. Starred 0.15. I know that looks like an S, but that's 15. So again, this is something where it's important, right? It's important to understand that. It's important to understand what the market is expecting, because that could influence or has potential to influence the overall kind of mentality, right, of the market and that kind of thing. But again, these are just data points. If they're important enough to be put in the slide deck, and Keith says yes, please, they're important enough for you to be tracking yourself. If we go back to that deck, awesome, yeah, perfect. And then now we've got sales and earnings growth. Only about 20. What did I write down? 20 companies out of 499 have reported so far. But track that. You can take a look as to what is the rate of change, which direction is it going, and that kind of thing. So keep going down. Futures positioning, right? This gets updated weekly. Again, this is a good assessment as to what is transpiring, kind of what is the overall sentiment in the market, what is their positioning. And again, typical, one that we have been on the other side of for the last few weeks, where the consensus is long, and Keith and the team has been highlighting this. Euros longs, a dollar short in terms of consensus. We have the opposite component. Again, in here, I've talked about this on a couple other beginners guides, but really, looking at the Z score there. And if you can you blow up that slide there, Genron? Sorry, man. The Z score, the 1 year Z score, the kind of far right column, the just to one in from the right. Look at those, 2 times Z scores, either positive or negative, really are ones that you should be kind of circling and highlighting, or again, like that rate of change. I've talked about this before, but that week over week, rate of change, which direction is it moving and how does that compare? The Z score really helps you, evaluate the comparison in the trailing last 12 months. But yeah, again, this is one that you can kind of get it's updated weekly, so it's a bit more impactful on when it's updated. But it's always good to understand where consensus is versus your own positioning inside your portfolio. We don't always have to be contradictory to consensus. That's not the point of Hedgeye. We're not always, but it's just good to know kind of some external factors that could impact some of your positionings within the portfolio. If we keep scrolling down, I think so volatility, again, obviously, 3-factor model, price, volume, volatility. Now we're getting into the volatility. These are incredibly important. I shared that this morning in regards to the multiple components of volatility that I track every day and write down. The IVol table has been a very I'd say a prominent question or discussion point within the arena on the beginner's guide since the beginning. I believe in episode 1, I did a rundown as to like how I read through the eyeball data and that kind of thing. But obviously, again, this is just a tool in the toolbox. I do humbly believe that, given the number of questions on the macro show and kind of the number of questions around almost anchoring on the eyeball data, I suspect that a few too many anchor a little too strongly or anchor a little bit too much on the eyeball data. This is just one tool in the toolbox. It's an influential piece in regards to, really influencing the sizing in terms of, how big do you get. Just because you've got a premium here on say Qs, doesn't mean that you don't short Qs at the top end of the risk range. It just, kind of influences perhaps how big you get in terms of the short position. So again, this is just a tool in the toolbox. I just want to reiterate that fact. If we keep scrolling down, I think we're going to get into the different components of volatility, right? Yeah, here we go. So we can move through these relatively quickly, Genron. So again, track the move. Again, the time frames day over day, week over week, month over month. So go move, high yield. I think it's triple B next. Oh, sorry, macro vol. So again, this is all of the key components here in terms of VIX, RVX, VIXN, that's NAS vol. GBZ is gold volatility. OVX is oil volatility. So again, for anybody that's new, VIX is the volatility on S&P 500. RVZ is RVX, RVZ. Shit, now I'm confusing myself. RVX is Russell vol. NAS vol is on the NASDAQ. GBZ is gold volatility. OVX is now I'm all freaking all over the place. I got too many things going through my brain. But anyway, oil's at the bottom. So again, day over day, week over week, and all that kind of stuff. So let's keep rolling. Yeah, we got global currency. So FX vol. A couple weeks ago on the macro show, Keith mentioned that FX vol really only has 2 buckets of volatility. That 9 number is kind of the key pivot point. So 3 to 9 is sort of investable vol. Above 9 is the F bucket, and really means you invest in dollars. So we've had a big pivot there recently in terms of it had been decreasing over the last really couple months and recently kind of moved significantly higher here in the last basically week or so. So that's a big call out. Obviously that's where the red, oh, sorry, General, can we just move back to that? Yeah. When you see red or green arrows, yeah, that's probably something to bloody circle, right? And star, anything like that, right? So pay attention to the arrows. There's reasons why we use them. All right, next. Triple B corporate spread. Yep. So again, another big one to be paying attention to.